So let's talk about a company called Zenith Insurance. On the surface, they look like an absolute titan, a real success story. But underneath all that shine, a huge crisis was brewing. Today, we're diving into the story of how this company, which was flying blind, completely transformed risk from a hidden threat into its greatest strategic weapon.
And this quote right here, it just hits the nail on the head. This one sentence perfectly captures why Zenith was so vulnerable. See, they weren't looking at the whole picture. And that siloed, disconnected approach was about to be tested in a big way.
Okay, so let's set the scene. We're talking about the years between 2015 and 2019. Zenith Life Insurance was on an absolute tear. Their premium growth was blowing past the rest of the industry. They looked unstoppable. But there was one critical thing missing from this incredible growth: guardrails.
Now, if you look at their strategy, each move, in isolation, kind of made sense, right? The finance team was chasing those high yields, the sales team was crushing it, grabbing market share. But here was the fatal flaw. All these decisions were being made in their own little bubbles. Every department was hitting its targets, but absolutely no one was adding up the total risk. And this is what that looked like in practice. You had Treasury managing financial risk over here, actuarial handling insurance risk over there, and so on. Everyone was in their own lane. The big gaping hole in the middle? No integrated view. Not a single person had a clear picture of the total risk the company was taking on. They had a strategy for growth, for sure, but they had absolutely no strategy for risk. So in 2020, all those cracks in the foundation started to give way. And it wasn't just one thing. Oh no. It was a perfect storm of 3 different shocks hitting them all at once, and it exposed just how fragile Zenith's success really was. First up, a massive, unexpected drop in interest rates. Now, if you're an insurance company with long-term promises to keep, this is basically your worst nightmare. And it had an immediate, and I mean dramatic, effect on Zenith's balance sheet. So what does that actually mean? Look at this chart. The value of their liabilities, that's the money they owed to policyholders way down the line, just skyrocketed. But the value of their assets, it couldn't keep up. This created a massive mismatch. And suddenly their solvency ratio, their safety cushion, was dangerously close to the legal minimum. They were on the edge. Okay, so that's hit number 1. Hit number 2, the economy slows down. And what happens? People start canceling their policies way more than Zenith's super optimistic models had ever planned for. This torpedoed their revenue and showed a huge disconnect between their sales goals and reality. And just when you think it can't get worse, bam, hit number 3. This one was internal. An audit finds all these weak controls in how they brought on new agents, and boom, a huge fine from the regulators. It was another critical failure, this time on the compliance and oversight side. You know, any one of these things on its own, probably manageable. Annoying, but manageable. But all 3 together, that wasn't just a problem. It was a full-blown strategic threat to their capital, their earnings, and their entire reputation. So at this point, the board finally had to face the music. They realized these weren't just separate fires they needed to put out. No, these were all symptoms of a much, much deeper, systemic problem. So they brought in outside help to find the root cause. And what did they find? The one thing that was missing all along. Something called a risk appetite framework. It sounds complicated, but it's really simple. It's just a way of defining how much risk you're willing to take to get where you want to go. Zenith had these crazy growth goals, but they'd never actually defined their tolerance for risk. They were basically flooring it in a sports car without ever checking if the road ended at a cliff. And yeah, the big review pretty much confirmed everyone's worst fears: no risk appetite framework. Their whole 3 lines of defense model, which is standard stuff for risk accountability, was frankly a mess. Their risk reports were fragmented and always looking in the rearview mirror. And worst of all, the biggest decisions about money were being made with zero connection to the risks they were taking on. They were constantly reacting, not strategizing. Okay, so that diagnosis was pretty grim. But it was the wake-up call they needed. This led to a complete overhaul of their entire approach. Not just a patch-up job, but a whole new risk strategy, built from the ground up on 4 foundational pillars. All right, so let's walk through these 4 pillars of their transformation. First, they had to reinforce governance to set the right tone. Second, build a real, enterprise-wide risk framework. Third, strengthen those lines of defense to get clear accountability. And finally, start optimizing their capital based on risk, not just on chasing returns. And it all had to start at the very top. The tone from the top, as they say. They created a brand new board risk committee and appointed a chief risk officer who reported directly to the board.
For the first time ever, risk wasn't just some boring compliance checkbox. It was strategic. It was part of every major conversation.
And that new attitude filtered all the way down through the organization. Look at how their 3 lines of defense changed. Before, the business units, the first line, were just chasing revenue. Now, they owned their risk. The second line, risk and compliance, went from having no teeth to being empowered to actually challenge bad decisions. And internal audit, they went from reactive to proactive. Accountability was now crystal clear.
So, the big question is, did it work? Let's fast forward 3 years to 2023 and look at the actual measurable impact of all this hard work. Did it pay off?
Check this out. Their risk-adjusted return on equity, which is a fancy way of saying how much profit they made for the risk they took, shot up by a staggering 22%. And this is so important. Managing risk better didn't slow them down. It actually made them more profitable. First big win for the scoreboard. Their capital position got way healthier. That solvency ratio jumped by 18%. That means they had a much bigger, much stronger cushion to absorb any future shocks that came their way.
And it wasn't just about having a bigger safety net. They also got incredibly stable. Their earnings became 30% less volatile. That means more stability, more predictability, which is exactly what investors and regulators love to see. No more wild ups and downs.
But honestly, the most important result wasn't something you could put on a spreadsheet. It was cultural. As this quote says, the entire company's mindset changed. Risk management stopped being the department of no and became a team that actually helped create sustainable value. That's a huge shift.
So, Zenith's story really boils down to a powerful question that every single business leader needs to be asking themselves. It's a simple one. What risks are we really taking to achieve our growth? It's not about avoiding risk, it's about knowing which risks you're taking and why.
And that leads us right to the final and maybe most critical question of all. It's one thing to take risks, but are you being paid enough for them? Are you being adequately compensated? Answering that question, well, that's the very heart of turning risk from something you fear into your biggest strategic advantage.